Hello, folks. This is David Russell, Global Head of Market Strategy at TradeStation. Hope everyone's doing well. I'm getting a small error message on one of my streaming platforms, but I think I am good on the other ones. Let me just check something. Sorry, I want to just really quickly make sure I'm live on YouTube and Facebook. I think we are. Looks like we are going here. So I want to, 1 second. All right. I apologize, folks. That was a strange thing. So here's some disclosure I want to show you. Great to be with everyone. So last week we were talking about volatility and ranges widening, and that's more or less what we've been getting. So we're going to get into all of that very quickly, showing you these disclosures. I'm going to show you, I'm going to just put a few disclosures here in the chat. And look, like S&P is continuing to push to the downside as we start this webinar. All right. So if you want to go to tradestation.com, and then you go to the main, on our main page, and you go to the Insights blog. You can actually see we have an article today. It's called Volatility Swamps Wall Street. And the guy in a kayak, you might want to check that out. Some of the points we're talking about in terms of the S&P 500 are covered in that. So there we go. And let me show you some standardized returns of some of the ETFs we're going to be talking about. So basically, what's interesting to me here is that we essentially see, I mean, one of the things that's happening is that there's a strange weakness in the dollar that we talked about. And, this might create a sort of unusual situation that I think I'm gonna be getting to. I want to just mention that. So I normally say, this webinar is all about the sectors. You look at the big sector funds, some of these things here in front of us, is this sector doing well or whatever? And, I think it's also important to realize right now that in many ways, it's all about the S&P. It's all about the NASDAQ. This is now a highly correlated index-based market. This is the time when people, are going to be focused on trading futures. They're going to be focused on trading the indexes, and getting too interested in individual sectors or individual stocks is now a good way to get kind of sucked into something that, might be, difficult. So I want to point out here that if we actually look, I was looking at how we see, well, first of all, this is our futures, um, workspace we've shared with you guys. And, what's interesting about this is that the signals really, in some ways, this was a sell signal that we had essentially back on Friday. But even here, this, what we basically started to see, kind of in the overnight here, was that, the stochastics were not overbought, but the 50-hour was falling. MACD was just starting to turn down. And these are the sort of things that this workspace is for. This is for this is essentially for trading futures and for kind of being focused on the trends in futures. And this is some of the signals that, I mean, that hasn't given any kind of sign of this thing stopping. So I want to kind of point that out. And I also say that right now, one of the things we're seeing, these are the standardized returns of our ETFs. When we go to key ETFs on this and we look at, what's outperforming, it's basically healthcare, consumer staples, real estate. So we've been talking about this outperformance in global, I mean, in safe havens, and this was a big warning sign. Look at what the weak sectors are in the last week. For example, financials down 8%. Consumer discretionaries, tech. I mean, these are the parts of the market that are more economically sensitive, more risk on. The sell-off in financials has really been pretty interesting to see how they went from being so favored to so kind of liquidated. And it shows that there's been a very rapid deterioration of the cyclical story, which is something we've talked about a lot. People are concerned about the economy more and more, and that's why financials are getting hit. So I also think it's interesting to realize when you look at some of these things like the safe havens doing well, there's things like the equal weighted index doing well. There's actually more stocks hitting 52-week highs today. So you get some of these strange things hitting 52-week highs, some of these like property and casualty stocks or healthcare stocks or whatever they are. But I think it's also important to realize that people get kind of sucked into those as a kind of safe haven, but then they can, if the market does continue to weaken, they can just get unwound really quickly. So from my perspective, continuing to see some of these individual names inching to new highs, and I don't have it on here today, but we had 24 members of the S&P hitting new 52. We have more 52-week highs today than we did on Friday. it's showing that people are still trying to buy this market. It shows that we're not yet at capitulation, and I think that's like an important thing to think about. If we look at the VIX here, let's go over now to our trading view, and the VIX here is pushing back basically to its highs from over here. In fact, it looks like it's getting ready to push above that high on December 18th. That was when the Fed basically said they were going to hike, they were going to cut, I'm sorry, twice in 2025 instead of four times. That was when the market had that violent sell off, and now VIX is pushing above that level. And in some ways, what is worrisome about this is, I mean, worrisome if you want to be bullish. I mean, if you're bearish and you like volatility, it's a great thing. The key thing is that this is a slow grind up, and it actually creates a potential here for something that is more subversive for a structural bull market, more kind of just everything just crumbling at an accelerating pace. Now, I want to just kind of point that out because, really getting above this level could start to get us into that point when things get far more extreme and far more dramatic. And so I want to just kind of point that out, that messing around with individual stocks or finding this one-off company here, this random healthcare stock that's up 3% today and thinking it's great or something, that this is the environment when that sort of thing, doesn't, it can become tricky. So focusing on the big indexes, the big levels are really right now where the big money's going to essentially be focused. And that fits into the cycle of what we call our volatility cycle. When we look at stocks, when we have a period of high volatility, people want to focus on the indexes and look for correlation, because the other thing is, when the market does bottom and rebound, the easy money, so to speak, will be in the big indexes. So getting your heads all tied up in individual stocks at a time like this, and some of the stocks that do well when the market's crashing will not lead on the way back up. They're just these kind of random things. So just the kind of thing to start getting the mental process ready for when the rebound actually comes. How do we want to see that? It will not be probably healthcare and REITs and consumer staples leading the way up when the rebound comes. So just realize that there's a time when relative strength is not as meaningful. All right, so look at the S&P 500 here. So here's actually our article. Go to tradestation.com, go to insights. So by the way, on this webinar, this is state of the market. On state of the market, we talk about the big indexes and the big sectors. On Thursday, we do market trends. And on market trends, we talk about kind of individual stocks or more nuanced trends. We did an article here about the weak dollar and the global trade. We provided a list of ADRs, which are foreign stocks trading in the United States, in this, and I want to let you know that I updated that list to include NASDAQ listed companies like Alibaba and stuff that I didn't have before. So if you guys saw market trends on Thursday, you can get the updated list here. This is the article here I'm talking about today. I also want to briefly mention we did another one a while back about, is Apple the next Intel? And this is on the 23rd of January. But I did want to point out that one of the stories that kind of got missed in the news last week was that basically Apple was going to delay until next calendar year their Siri AI thing. That's a really big deal. And I think it's interesting that Apple, is still pretty high up here in its overall range in the big scheme of things with this channel. We did a trading view idea on this today if you want to check it out, but I want to just kind of point that out. Remember, Apple is in tech. It's in XLK that we're going to get to. And the thing that I think when you look at XLK that's a little bit worrisome is that some of the biggest names like Apple and Microsoft, you could look at them and say, they do people might see space to the downside here. I mean, we had talked about Apple going down to this level. Potentially, we did a trading view idea on it, and it has essentially gone down to that 52-week low, and it did have that space, and it filled that space. But when you look at it here, I mean, in the big scheme of things, people could probably see more downside in like Microsoft. So Microsoft and Apple are, I think, the two biggest in the XLK, and then Nvidia after that. So I mean, the big fish are sinking, so to speak. So I want to kind of point that out. When you look at them, the big names potentially have space. So if you actually did see Apple, work its way down this channel, what would that mean to XLK? What would it mean to the Qs? And that, I think, is the reason why when we go back and look at the VIX, maybe it has not yet hit its high. So I want to talk about something else here very quickly, which is the RSI on the daily chart on TradeStation's platform here. There's a workspace we've worked with at different times. I want to highlight RSI is under 30. First oversold on RSI since this bull market. Well, my definition of the bull market is November 2023, because that's when we really took off from the 200-day moving average and things really started ripping. But there's a first oversold on RSI since late 2023. So, I mean, if it stays here and the day closes, it's going to be blue down here at the bottom. So I want to point that out. Now, Let's look at RSI back here. I think it's important to compare very quickly two different moments in time. First, look here back in July and August, when the market was rallying to new highs, and RSI got really overbought. Now, see, look, it rallied to new highs and it crashed. Now, at that time, RSI made a high and a higher high, and then it crashed, and we had this violent rebound. And we were doing this webinar at that time talking about the fact that the market was, by various measures, very much oversold, and leaning on the long side might be something that probabilistically kind of made sense. Now, that was a strong uptrend with a fast, violent pullback. You can see that RSI made a higher high. Now let's look over here. The market. Now look at this. These are a series of nice, strong, very strong higher highs. This little move here, starting in like kind of May, June, July of last year. It's a nice, steady move, with higher highs and higher lows. Now look over here. You basically have. I mean, look at this time. We basically went from like 52.50 to like 50, around 5,700. This time we barely made. I mean, we didn't even go up 100 points. We hit a peak in December of right around 6,100, and we did not even go a full 1 percentage point above that high. So here our highs were like full percentage points higher. This time our highs were fractionally of a percentage point higher. This is a stalling kind of peak. And so when you have that sort of thing, it doesn't necessarily mean that you're going to have a sell off, but it does mean that it's not a strong breakout. Now the market could have sat there and consolidated, and then if things had gone better, then we could have been talking about new highs. But the fact is now what we do see is we have something that is more damaging technically, which is we have a false breakout, which was a very feeble failed breakout, and RSI was making lower highs, which is divergence. So on the daily chart here, I just want to just highlight the difference between these two moments in history, because one, RSI went overbought and it basically pulled back. This time RSI was fading from overbought and it just keeps crumbling. So this is what shows you what happened. Now, the other thing on this is we have the 200, 150-day moving averages. You can see how the 50-day, look at how it's been getting closer and closer to the 100-day moving average. The red line is just inching down into there. So that also shows you that essentially this longer term momentum is potentially really stalling here. So I think that's an important thing that we can see from this chart. So that's the daily. Let's go to the main thing we do in this webinar, which is the weeklies. Wait. Also, a few things I want to mention is that the earnings estimates continue to kind of degrade. We saw a relatively sharp slowdown in the earnings estimates for Q1. That is detailed in the article of the guy on the kayak if you want to check that out. The NASDAQ officially hit a correction territory, and we've been lower on that. We're also now in a negative month and a negative quarter. So let's look at really quickly, make this a monthly chart here. And basically, you can see we're in our second negative month. And if we make it a quarterly chart, you can see we're in our first negative quarter. Let me actually just hide these drawings. This is a first negative quarter, and you can actually see that this is an outside, candle on the quarterly chart. So you can see we made that false, we barely inched higher, and then we crushed to the downside. So these patterns are kind of consistent with what I'm talking about here, which is a kind of stalling, failed breakout. Now, it's also interesting that we had 6 straight days last week, well, the preceding week into last week, with moves of at least 1% up or down, absolute percentage moves. And that was the first time that it happened since November of 2022, which was immediately before and after the election that year when Biden got elected. So there was a lot of negativity and then a huge rally after the election in 2020, November of 2020. So basically what we're seeing here is we're seeing, pretty significant sort of moves. And also on a weekly basis that the candles are getting bigger, the range of the high and low in the weekly candles are getting bigger and bigger. So these are some of the things that we're seeing when we use some of our specialized trade station charting. So I think it's also important to realize now, if you look at what's happening with financials, if you go over and you look at junk bond spreads, it's on one of these measures of credit quality, it has not widened out very much. So we're in a spot here where there is still potential for a lot of these issues to kind of widen throughout the financial system. We haven't seen spreads widen. We haven't seen the jobs data and other things weaken. So I think we're in a spot here where things have degraded a lot, and now there is some potential of things kind of continuing to spread. And I almost feel like it's one of these things where if a person like you know, I don't know if something horrible happens and a person like stops breathing or something, you have a certain amount of time to get them breathing again before brain damage occurs. Something like that. That's kind of where we are now with, I think, the way people feel about the economy and the stock market, where when we have this uncertainty and this kind of these negatives happening, there's a fear that things will get worse in the economy. They haven't been confirmed yet, but as time goes on, if we continue to have this kind of uncertainty with these, with these, tariffs and everything else like that, we could start to see, okay, this volatility in the stock market, now it's going to start appearing in initial jobless claims. Now it's going to start appearing in payroll losses. Now it's going to start appearing in other sorts of parts of the economy. And I think that's kind of where we're on that risk now, where people are starting to fear that this will spread to those other levels. And when you consider how long we've been on this uptrend, and you also consider that the economic data is still pretty good, it does actually create more risk and space potentially for things to get worse, just like we said about Apple. For example, when you look at Apple, a person could argue this stock, there is potentially space there, to move lower. And if that happens, what does that mean to the Qs? So I think that's where we are now. When you look at the VIX just kind of parked at that level and everything else. Now, let's not forget that we have CPI on Wednesday. So we might need to have that event, maybe an event like that, we have to kind of stall and wait. Maybe there will be something of a rebound, and if people really want to sell, maybe they'll wait until after that. So I want to just kind of point it out that all that is very much kind of all these sort of possibilities, and that's why focusing on the futures and that kind of short-term momentum is the thing that kind of can make more sense here. I also want to make the point when I look at Microsoft is that when you look at the things like what Elon Musk is doing, that is something where, potentially if the government, cuts spending and employees and all that, Microsoft has exposure in terms of just people using Windows. So all those things are potentially something in there. So want to point all those things out. And also today, one of the Fed governors, I can't remember her first name, but her last name is Kugler. She basically was, keeping a pretty hawkish position overall. So I think this is, kind of keeping the position that the Fed is not yet going in a direction where they're going to necessarily just step in and make everything, dovish again. So I think these things are all things to think about in terms of, there is still some potential for things to maybe even, get worse. It's not clear that they've hit a bottom point yet. I want to just kind of point that out. I also looked over on Google Trends. I thought it was interesting to see that recession risk is starting to shoot up as a search term. But I wanted to also just mention here. Now I'm got to look at the S&P. I'm going to go through these quickly, and in some ways, the S&P is really the big thing that matters. But we had talked about this 5,700 level, and we touched it, and we just blew through it. And I think right now, when we take a bigger step back, first of all, I think that one of the things I'm seeing here, look at this yellow line. Look at two different moments in history. This is basically the bull market coming out of COVID. And you can see that we rallied and then we flattened. You can see that these higher highs, and then we stopped making higher highs, and then the bear market started. So look over here, and we kind of see something similar. We get up, and then we stop making the higher highs. We move sideways, and we move lower. So look at that bull market. Look how we've retraced half of it. Exactly. This was the low in October of 2022. It was exactly a 50% retracement of the March 2020 move up to the January 2022 move. That rally brought us down to a 50% retracement. So now, I'm not saying that we're going to do that, but all I'm saying is if we were to retrace 50% of the move that we've had since October of 2022, it would point to 48.19. Now, just purely coincidentally, the previous all-time high was 48.18 back here. So if you look, this level, I mean, again, this is something that is simply out there, and no one should try to make any predictions like this, but it's just worth kind of taking these numbers and writing them up on your wall or something and kind of having an idea, is that this would be the high from before that last bear market in early 2022, and it would be a 50% retracement of this whole move. So that is right around 48.20. Now, a 20% pullback being a bear market, the CNBC definition of a bear market would be something around 49.18, and a 10% correction would be 55.32, which is, right around here. So as I look at these things overall, there's a lot of levels that you can draw on these charts. And I think right now, the fact is that we're inside of ranges, and I think that trying to actually identify specific levels is a little bit tricky because, like I said, the thing now that I think in many ways that is really going to be, impacting the market are those short-term hourly charts that we showed you before. So let me just stick with this now. All right. Let's look on the daily chart of the S&P 500 because there was a level that I identified in an article today that could potentially be the up point. If we get it now, this is a level I had seen, and now we're more below it. But the levels, first of all, was we had a level up here around kind of 58.50. If there gets to be a snap back to the upside, this could be a resistance point. But now, given the further downside today, people might also look to kind of 57 kind of 83-ish, which was an important level going back. That was the Tuesday of election day. That was the close that day, and you can see we're broken below it. It was a support level back in January. So these levels now, in terms of daily moves, 58, 57.83, and up to kind of 58.50. Those are the levels now that kind of stand out. But even then, that would require at this point something kind of more substantive. And I think, given the overall situation, expecting a rebound to those levels this quickly might not actually be, clearly in the cards. If anything, now I think on the daily, people might want to be moving down closer to the lows. If you look here, we have a level closer around 57.34, which was the low of last Tuesday that you can see we tried to hold at different times, last week. So maybe 57.34 is kind of now more where people are looking. All right, now we look at the cues back on the weekly here. Um, I mean, again, last week we had kind of pointed out, we had talked about the S&P going to 5,700 potentially. We had, we also talked about the Russell, which I'm going to get to. But when we look here at the cues, I think also we see, if anything, I mean, some of these lines out here, I mean, this now, I mean, the next really logical support area would be, significantly lower. But again, we're at a spot here, like where I said, where we have to be careful being too focused on long-term levels. The market could kind of stabilize and some sort of level could form where we make a higher low on a 15-minute chart. And I've seen things like this happen, and you get a violent, sort of counter trend rally. So this is the sort of thing when the shorter term time frames, the 15-minute charts, the hourly charts can give you much more clarity. But on the cues here, like I said, there is space in this whole area. This can be all kinds of turmoil and volatility in these levels here. Now, I also just mentioned the Apple news, the thing I said about Microsoft breaking those levels. All those are issues here, which are, problematic for the cues. Now, the Dow Jones Industrial Average, we had mentioned how this one was holding up better, but now, this is also at a spot where people could be looking for this to break to the downside. And then, if you look at that, we have a potential level over here, right around 40,000, which was basically that high back in May and then the low back in early September. So again, this is something where, there could simply be significant sort of volatility where the weekly levels are not as important. But I think it's important to realize that this is now coming down to a level where people might actually look for this to kind of lose that safe haven status and break the support. So it's interesting how we basically failed to hold the 50% retracement on this. One thing you'll see is, as things, get, as the selling intensifies and the bearishness intensifies, is it bounces become simply much, much weaker. And that actually shows we're entering that kind of accelerated phase of the move. And it gets to a point when it gets accelerated and then it gets frenetic and then it ends. And the thing is, we haven't gotten to that point yet. And that's the reason why kind of waiting and being ready to plow in, if you want to be long, waiting for this sort of point when it gets more excessive is more the kind of way that could make sense. And being careful, not to have those individual stocks, but just being ready for the indexes. That's really where, the clarity will be. Now, the Russell, last week we talked about the Russell could go down into the summer lows, and look where it is. So basically, this is exactly the sort of thing that we had seen. And the Russell was somewhere up here when we talked about it, and now it's down pretty sharply. This is something where I think that the low basically from last August remains very much in play. And beyond that, we still have lows lower than that going back to last spring. So I think here, when you look at it, the weak get weaker, so to speak, in a market like this. And I think when you look at some of the situations with economic news or anything else, something like the Russell, a lot of it was hope that there'd be M&A and stuff like that. But if we have a significant weakness in the market, even things like M&A are less of a narrative. So I think that's just something to think about here, that this is something that the weak get weaker. And it's a good lesson to remember. And it also shows here that this one still potentially has some space, and this is not necessarily the most firm support. I mean, the 52-week low is actually back here, and people might look for it to go down and actually, base out closer to those levels. Now, I got to look at the dollar index. We did an unusual trading view idea that you guys might want to check out over in trading view. When basically the dollar index last week fell 3%. So that has almost never happened um, in all of history. We did a special trading view idea on it if you want to look here. And It's called a strange event in the dollar. But it was interesting to me because it does create a possibility. And something you guys might want to Google is the Mar-a-Lago Accord. There is an idea, a rumor, a theory that Trump is going to try and do something like Bretton Woods or what Reagan did called the Plaza Accord. Now, this is kind of crazy, wonky, international finance stuff, but it could result in further weakness in the dollar. So I want to just kind of point out that we are at a risk here where we kind of see, you know, when you see the Nasdaq and the big tech stocks selling off, that in many ways is very synonymous with American assets or American stocks. And then you see the European stocks outperforming and things like that. We see the Germans are going to invest in their economy and the Americans are cutting spending. You put those things together, and you also consider the fact that American stocks traded higher multiples. They've been outperforming for years. There is a potential here of a more significant shift of investor dollars away from American assets and overseas. So we could be in a period here that is something more significant of money moving away from American, stocks, which essentially is the Nasdaq in a lot of ways. So then we have to realize that this could be a bigger story and a bigger trend, and it could be something that is significant for some time into the future. And so I think that's just important to kind of realize this move in the dollar index last week was absolutely un untypical, atypical, absolutely irregular to see the dollar get crushed and the equities get crushed the degree that they did, and it could suggest something more significant is happening. Now, we had talked last week about the 10-year Treasury yield, holding 410, and it is doing that. And this is also consistent with what I just said. Is it basically the market's getting smoked and the 10-year is not hitting new lows? This also tells you that people are moving away from dollar assets. And I think this is something we have to be aware of. I mean, if we see yields having held 4% and move higher from here, I mean, that's another potential issue for the market. So my view was that they'd hit 410, or that was kind of what the charts were, my charts were kind of suggesting. And I think here we're in a spot where they have held that level. And if anything here, the risk is to the upside in yields. And I think this is something that is also potentially problematic. Now, look at the other big indexes, XLB. I've been talking so much of these big macro things, but again, we had talked about the fact last week, XLB materials, lower high and a lower low could be in the cards for this one. XLC communications, in many ways, there's one of the stronger areas, but again, probing back down to these levels might be really what people look for, this level around 95. This has a lot of potentially positive things in terms of the fact it doesn't have the tariff exposure, some other issues like that. Nonetheless, this is something here where it's heavily owned, and this is an area where people might be kind of looking for some opportunities. This on the other side of whatever selling is happening, but it's also important to realize that this thing has not yet hit any clear sort of support levels. Now, XLEs, when these things with energy, it's a weird kind of freakish thing here, and I think that the main thing energy is going for it is they trade at very low multiples, but also here, there is space. And the potential here, pushing down toward 83 is something people might see. We've talked about that level, and it's holding because it's kind of a safe haven, non-tech thing. But again, as the dominoes fall and as the weakness spreads, something like this, because just one day it gets liquidated. That's XLE. Look at XLF. One thing I'll mention that's kind of interesting, but this also could be one of these kind of idiosyncratic things, is to look at a name like, Allstate. I mean, again, the strength we're seeing now, I mean, the company's making highs with things like the property and casualty names. Allstate has been doing kind of well. But again, the weakness can spread throughout the area. So the main thing kind of holding up financials is property and casualty. But again, this is something that went from bullish to bearish really quickly. And I think we have to realize this is also something where people might look for this kind of to widen out. And so XLF here also, a lot of these levels are getting less and less important as the S&P and the overall correlation gets gets more important. Looking at XLF and all these things might not really be the best use of your time now. What really matters is what is the S&P doing, um, and what are the Qs doing, because they're far more important to the overall market. XLK here, I would just mention again, this is has this potential level from September, but I would mention over here very quickly on the daily chart of XLK. Look at names like Micron. Look at names like Texas. I mean, if you look at this, also has not. I mean, this has been can this break down to new lows? That now becomes a risk. Names like Texas Instruments are hanging in there. There are some of these names here that have not yet done a lot to the downside. And one of those names is Palantir, which is just now breaking down. These are all XLK members. And we'll just kind of point that out. We did a trading view idea last week on Palantir. We talked about the fact that basically it had this bearish triangle. You can check it out. But again, as they're selling spreads, these names have not yet been truly hit, like Apple or some of these other names. It's spreading, and I think that's what we're seeing yet. So it does not yet suggest that we're getting any kind of real capitulation. XLP, things like consumer staples, it'll be a cute little thing that does well. But again, if the market really continues to weaken, now we can look and we can say, all right, we have a double top. We went back up to the level where we wanted to go. But now again, consumer staples, that was a fun little, counter trend move, a fun little bear market rally. But now it's kind of hit that level. Real estate also has been kind of strong. It'll do okay because the interest rates and the fear of the economy. But again, this is also something here that's just kind of stuck and doesn't have, at this point, people will probably be looking, all right, when the market does bottom, I'm going to buy the big tech. I'm going to buy Qs. I'm not going to necessarily be looking at REITs. So this is something also where it had this little outperformance. And now at this point, it's not giving any kind of clear signals. It's still in a range. And people might actually say, you know what? Let's actually see if this thing does a little, channel down. That might be the next thing we see in something like real estate. So we had talked about that potential strength in it. It happened, but that has now passed. Now, there's a similar sort of potential here for a channel in utilities. And I think we're going to also just realize that, again, it still has the AI theme in it. And so this is just something I think we need to realize in utilities. Healthcare, in some ways, is the most interesting because it has actually crossed. No, it held this 50% retracement here. And also, if you look at the bearish move, it has gone more than 50% above the bearish move. So that actually invalidates the bearish move. And the first bullish move up got validated by the 50% retracement right here in mid-February. So XLV continues to show some overall relative strength. But again, it's something where something might happen with Medicaid or some other thing like that, some government cut, and this thing could get to be risk. So I just realized that all those things are out there. There's also a risk of a government shutdown this week. So these are the sort of things where people looking for opportunity, things like healthcare have been kind of fun, but now it's like, big index, that's where the focus is now. And XLY, I mean, we look at this overall, Tesla and Amazon, problematic. And we were writing about things like Carnival Cruise. I'm sorry, we were writing about RCL on TradingView, but these names are all breaking down now, these discretionary leisure travel names. So something here like XLY, this is very much an economically cyclical area, XLY. And this is something where it could behave more like the Russell when it could just get more violent to the downside. And to just kind of realize that is that this is an area here that also has a lot of space, and there's no reason for anyone to be really at this point in time overly confident in something like this when the claims numbers haven't hit. This might be something we need to see claims go over 300,000. We might need to have people say there's a recession before something like this actually becomes something where the big money wants to go. So I ran a little bit over it. We're really in some unusual situations here. I want to just kind of mention that. It's great to talk to everyone. And I will see you on Thursday in Market Trends. I hope everyone has a great day, and I'll see you later this week. Don't forget, CPI is on Wednesday morning.